There's actually also a bond volatility index. It's called the MOVE index in the world of fixed income. So here's a one-year chart of that index. As you can see here, too, we have seen volatility come down on the bond side. It's usually tied up with economic and policy uncertainty. So let's talk about not only what it has done this year, but what we can expect in 2020. Rob Waldner is here to help us through that. He's Invesco Chief Fixed Income Strategist. Rob, thank you for coming in. So, not surprising necessarily that we have seen the bond volatility come down because expectations seem to be pretty clear, at least going into the early part of 2020 from people, what they expect to see from the Fed, for example.
Yeah, it's certainly to be expected that equity volatility and bond volatility might move together. There's actually a CVIX, too, for currencies, which does the same thing, but for the currency market, and that's also coming down. Like the VIX index, it's at its lows of the year. You know, fundamentally, what this is telling us is that policy uncertainty and economic growth uncertainty has eased. So we know throughout this year that we've had policy uncertainty around the Fed, trade issues, Brexit. There's a whole bunch of things that have been really problems for the economy this year, as well as fears about recession. We think all that's kind of cleaning up as we go through the end of this year.
I'm curious, though, how would an investor, how would we use, great to know the volatility, but what you just said when we're talking about, say, the MOVE index, we know all of this without having to look at the volatility index. So how do I use that if I'm making a decision whether I'm going to park money to the side to try and protect it? It seems as if it's just repeating what we're being told when we hear a statement from the Fed or we see these in the real world.
Well, it is giving you a measure of how much it would cost you to protect your portfolio. If you had a portfolio of equities or currencies or, treasuries, it's a real measure because it's expected volatility. It ties to that underlying cost that it would cost to insure that through options. So that's the one thing. It can tell you how cheap buying protection for your portfolio is. The other thing from a macro perspective is just it's a good measure of how much, where the market's fear gauge is, if you like. Right, so that's also important information. When we think about it, though, looking forward, in our view, the economy is going to have relatively good growth, and a good model for the next year might be something like 2017, where you had decent growth, you had very few sort of policy issues floating around, and you actually had central banks very easy in actually expanding their balance sheets. That's exactly what we're going to have in 2020, is decent growth, expanding balance sheets. If you remember 2017, we had very low volatility for most of the year.
So when we have people question this 60-40 portfolio, what's your reaction to that given everything we see with the MOVE index?
Well, the questions around the 60-40 portfolio are around the correlation between the equities and fixed income, not just the level of volatility, but I think what we can say is that the protection that the fixed income market can give you now at yields where they are is much less than it could give you in the past. So we do think it's worth rethinking a little bit the 60-40 portfolio.
Rob, quickly, any pockets of fixed income that you like heading into 2020? Is it government? Is it muni? Is it corporate? What do you like?
So broadly, what we think about in fixed income right now is that for the last year, the trade has been what we call late cycle trade, which means into duration, out of credit in fixed income, right? If this cycle is going to extend, which we think it is, you're now going to have investors going to have to switch back to sort of a mid-cycle or more growthy portfolio. In fixed income, a more growthy portfolio is credit and out of duration. So those IG bonds that had tremendous performance last year may lag relative to lower quality high yield. And also emerging market currencies. So it's been a while since emerging market currencies have really been able to make any headway. We think that this might be the year for that.
Rob, thanks for coming in.
Thank you.
Appreciate it. Rob Waldner is Chief Fixed Income Strategist at Invesco. Appreciate it.
Hey investors, Zach Guzman here. Are you interested in learning more about the markets and getting the latest financial news? Well, then click right here to subscribe to our Yahoo Finance YouTube channel. Get the latest up-to-the-minute market analysis, big interviews in the world of finance, and information on how to manage your money every day wherever you are.